America's labor market is showing serious cracks. Hiring has cooled off, layoffs are climbing, and those help wanted signs are quietly disappearing from storefronts across the country. So, is this the start of a recession that'll crush markets? Or is it just the kind of economic hiccup that brings the rate cuts everyone has been begging for without triggering a full-blown panic? Today, we're cutting through the economic noise and breaking down what this labor wobble actually means for your portfolio. My name is Nick, and whether you're bullish on everything or preparing for a doomsday, this is one breakdown you can't afford to miss. Before we dive in, I need to make one thing crystal clear. I am not a financial advisor, and nothing in this video should be taken as financial advice. This is purely educational content designed to help you understand jobs data and market implications. If that sounds good to you, smash those like and subscribe buttons, hit that notification bell, and let's get into it. The latest US jobs report for August was pretty rough. Unemployment jumped to 4.3%, the highest since October 2021, while employers added a measly 22,000 jobs. But here's the kicker. Earlier data got revised down too. June's numbers were slashed from 14,000 to minus 13,000, marking the first monthly payroll decline since 2020. And here's the stat that should grab your attention. There are now more unemployed Americans than there are job openings. The Bureau of Labor Statistics showed 7.18 million job openings in July, a 10-month low, sitting below roughly 7.24 million unemployed people. And that's the first time since 2021 this ratio has flipped below 1. And that sounds terrifying, and it's definitely a red flag. But before you panic, these numbers are bad without being catastrophic. They're confirming what we already suspected. The job market's been softening for months. The catch? Well, jobs data trends start slow and then accelerate fast. If this labor market keeps weakening, we could see a cliff drop rather than a gradual decline we've seen so far. That said, let's not get ahead of ourselves. Yes, we're seeing clear signals of a cooling labor market with more job seekers than openings. But weekly jobless claims aren't spiking dramatically yet. They're just drifting upward. And this looks like an economy easing off the gas pedal, not slamming on the brakes. Meanwhile, markets are reading this labor data as a guaranteed September rate cut. At least a 0.25% is locked in, with around a 12% odds of a 0.5% cut as I'm recording this video. Whether it's 25 basis points or 50 basis points, the message is clear. Softer labor makes aggressive monetary easing much more likely. But what about globally? China's unemployment rate edged up to 5.2% in July from 5% the month before. Beijing's rolling out hiring subsidies, but weak demand and that troubled property sector keep pressuring employers. China's youth unemployment spiked to 17.8% in July from 14.5% a month earlier. It's a sharp reacceleration that's keeping policymakers on edge. Germany just crossed a symbolic threshold with more than 3 million unemployed for the first time in a decade. The UK is hovering near 4.7% unemployment, while Canada hit 7.1%, the highest since 2016, pandemic aside. However, it's not all doom and gloom. EU unemployment remains near record lows at 6.2%, showing some resilience. Japan managed to keep unemployment low at around 2.3%. The takeaway? Well, the global jobs engine is sputtering, openings are shrinking, and labor markets worldwide look pretty shaky. Remember this, for the first time since 2021, there are more people hunting for work in the world's largest economy than there are jobs available. And that structural shift changes how households spend, how CEOs plan, and how central banks react. So we know economies are looking weak, but this isn't our first rodeo. So what can history teach us about where we're headed? Let's examine the last 3 US financial crises, excluding the pandemic. 2008's Great Financial Crisis, 2001's dot-com crash, and the early 1990s oil shock and credit squeeze. Different causes, but one fascinating pattern. Unemployment lagged the crisis narrative every single time. Take 2008. As credit markets froze, labor didn't ease, it snapped. But unemployment didn't pick up until October 2009 at 10.2%, months after the worst financial crisis had passed. And that's why unemployment is considered a lagging indicator. And here's what's interesting. Equities bottomed first. The S&P 500 hit rock bottom in March 2009, well before jobless rates stopped climbing. Financial markets sniff out both collapse and recovery before jobs data confirms anything. 2001 was different, a slow bleed. The dot-com crash was quick, but hiring remained stagnant. Unemployment peaked in June 2003 at 6.3%, almost 2 years after stocks had stabilized. A classic jobless recovery. And this shows you can have persistently weak hiring without the instant carnage of 2008, but markets still bottom well before labor data improves. The early 1990s brought the Gulf War oil shock, credit squeeze, and quick market drawdown. The S&P 500's bear market ended in October 1990, barely 3 months into the crisis. But unemployment kept rising for 15 months after the official crisis ended, topping at 7.8% in June 1992. So where does today fit? It looks more like early 2001 than 2008 or 1990. We're seeing slower hiring and softer openings without strong signs of a credit crunch or imminent external shock. But here's the weird part. Stocks are basically at all-time highs. Unemployment typically lags falling stock markets in crises. If things are destined to get much worse, this would be an unusual sequence. If stocks keep rallying, jobs should eventually catch up. Of course, many argue AI could keep eliminating jobs regardless. Others say that the gig economy will mask unemployment. Either way, the stock market has entered strange territory relative to labor markets.
Oh, sorry, I just had to take a break from that video to check the Coin Bureau deals page. You know, the one place you'll go to get exchange sign-up bonuses of up to $100,000 and trading fee discounts of up to 70%. Or how about discounts on hardware wallets, as well as exclusive altcoin alpha in the Coin Bureau Club? Well, more information in the description. Now, back to the video.
Now, this assumes our labor data is rock solid. Reality is messier, with big distortions warping what we think we see. Let's start with immigration. When net migration surges, labor supply expands, so the economy can add tons of jobs without overheating. When policy tightens abruptly, labor supply slows down, and monthly payroll gains needed to keep unemployment steady fall dramatically. Barclays quantified this. If migrant flows get curtailed, potential job growth could drop to 60,000 per month over the next 6 months, way below what most analysts consider healthy. And that doesn't mean demand is dead, it just means that lower job additions reflect slower population growth. The gig economy muggles things further. Weekly jobless claims miss much of it because most independent contractors don't qualify for unemployment benefits. When people shift from regular jobs to the gig work, their job losses don't appear in unemployment claims. So you get lower claims even while more people are trying to piece together gig income. Plus, the Labor Department's 2024 rule tightened who counts as an employee versus independent contractor, making official employment data wonky. Multiple job holders climbed earlier this year before dropping, but summer saw another uptick, evidence of households juggling more gigs. Part-time work for economic reasons has also been trending up. Employers cut hours, workers grab side jobs to bridge gaps, but things snowball quickly. Putting this together, the picture isn't clear. A single unemployment print doesn't warrant victory laps or panic button. Even so, key metrics are tilting bearish. Right now, there are more job seekers than jobs. The balance is shifting. The big question, recession or not? Or are we already in one? A recession is when broad activity, jobs, income, production, sales, falls for months and confirmed by the National Bureau of Economic Research well after markets have moved on. Not particularly helpful for real-time decisions, but be that as it may. Beyond GDP, many use the SARM rule. Now, this is if 3-month average unemployment rate rises 0.5% above its 12-month low, recession is near. We're nowhere close to triggering this yet, so it suggests things are okay. But the test is whether the unemployment rate rises persist long enough to clear that 0.5% trigger. There's nuance at play. This cycle's immigration whiplash makes data fuzzier. More workers entering can nudge unemployment up without collapsing demand. And that's why analysts, including Claudia Sahm herself, argue the rule needs context this time. Fiscal and monetary policy adds another twist. Trump's tariffs started at 10% baseline, with higher levies for select partners, raising prices and dulling demand, a stagflationary combo that can trigger recessions. Flip side, federal courts ruled many tariffs exceed presidential power, the administration's fast-tracking Supreme Court appeals while prepping for refund obligations. And that legal battle could reshape policy and recession odds. And then there's the Fed. Softer labor data increased rate cut expectations. If policy eases at the right pace, it cushions demand before layoffs snowball. But balance is tricky. Cut too little or late, hard landing. Cut too much, reignited inflation. For now, weak payroll growth plus higher unemployment equals more cuts priced in. Exactly what textbooks predict at this part of the cycle. Everything hinges on whether unemployment keeps grinding higher and weakness spreads. And when it comes down to it, monetary policy is the most critical factor to watch. Is Powell too late, as Trump suggests? Possibly. But signs aren't screaming major recession is imminent, at least not yet. And what does this mean for markets? Weaker labor markets don't necessarily spell doom. The main worry signal, more unemployment than job openings, also flashed in 2021 without things breaking. You've no doubt heard the saying, bad news is good news, and that may apply over here. Some labor weakness, cooling growth, declining inflation pressure, with central banks cutting to stimulate and deliver a soft landing. And that's why we've seen stocks ripping higher. With rate cuts expected, dollar weakness likely persists, supporting risk assets. But panic could spike the dollar index. Gold is the textbook play. Softer dollar, softer yields, uncertainty. And that's why it's been hitting new all-time highs. Add central bank buying and demand stays sturdy. If landing is soft or bad, gold likely benefits, except in a total wipeout scenario. But what about Bitcoin? Easier policy helps, and Bitcoin thrives as a risk-on asset. But weak labor? Bitcoin has shined as a safe haven, so liquidity helps it, but labor stress doesn't kill it either. No guarantees, but Bitcoin is well positioned. So the bottom line, if data stays soft, not severe, we're looking at Fed accommodation without mayhem, a decent cocktail for risk assets. If labor gets worse, safe havens take the wheel. For now, don't overcomplicate an already complex market. Rate cuts support risk assets, stocks and Bitcoin are well placed, but keep watching that key economic data. And that's all for today. And if you want to watch our latest video, you can watch that right over here. And if you're not subscribed to the channel yet, why? You can do that right over here. That's me, Nick, signing off. Thank you guys very much for watching, and I'll see you in the next video.